Hi, welcome. We're talking about bonds today. Make sure that you have your worksheet, your in-class worksheet, so that you can follow along. In this video, we're going to talk about what is a bond, some advantages and disadvantages of bonds, and then we're going to go over some definitions. Okay, so first, what is a bond? A bond is a long-term borrowing contract. So when we issue bonds or bonds payable, it means we are borrowing money. It means our debit's going to be the cash because we're borrowing money. A bond bears interest and it requires periodic cash interest payments. In this class, we are always going to assume that our cash payments are made semi-annually or 2 times a year. So we will make cash payments, cash interest payments, twice a year on all of our bonds. Okay, so why do we issue bonds? We issue bonds because we need money. We want to finance a project. Maybe we need it for operations. There's all kinds of reasons. And when we want to we need some sort of financing. Remember, we had our financing cycle. There's really 2 ways we can do it. We can either issue debt, and one of the most common types of debt we can issue are bonds. Or we can issue stock, and that's called equity financing. So we have debt financing and equity financing. Debt financing is when we borrow money, often in the form of bonds, and equity financing is when we issue stock to raise money. Okay, we're going to next talk about advantages and disadvantages. There are advantages and disadvantages to choosing debt financing or bond financing over equity financing where we issue more stock. The main advantage of choosing debt financing or bond financing is that we don't dilute equity. So our shareholders still own the same percentage of the company. You can imagine if we issue more shares to raise money, then either shareholders have to buy more stock in order to maintain their same percentage of ownership, or it dilutes their percentage of ownership. So that's the main advantage. 2 disadvantages of bonds. First is a cash flow issue. If every 6 months we have to make a cash payment, then that's going to impact our cash flow. As opposed to equity, the only kind of cash payment we would have to make is if we pay a dividend. And we are not legally obligated to pay a dividend. We may choose to, but we don't have to. With a bond, because it is a borrowing contract, we are contractually obligated to make that interest payment every 6 months. So an impact on cash flow. The other thing is it's going to increase our debt to equity ratio. You remember when we looked at our financial statement analysis module, one of the things we looked at was how much debt do we have versus how much equity. How much of our assets have been promised away to creditors versus what's left over for our shareholders. So by issuing debt, then we are committing more of our assets to our creditors, specifically to the people who loan us the money under the bond contract. All right, there's going to be all sorts of definitions that we're going to want to know when we go to start doing our accounting for our bonds payable. So let's go over a few of those. The first is par value. We also call that the face value of the bond. That's the amount that we must repay when we retire the bonds or when they get to maturity. We call that retirement when we pay off the bonds. So the par value, it's going to be written right into our bond contract. Here's how much money you're going to get when we retire these bonds. The term is the length of time that the bond will be outstanding. So it might be a 3-year bond, it might be a 10-year bond. Remember though, bonds are going to be our long-term liabilities, so they're more than a year. If they were less than a year, they would fall into, they'd be more likely to be a short-term notes payable versus an actual bond. I don't think bonds are usually issued for short amounts of time. They usually are, 10 to 20 years. Okay, interest payment periods. Remember with the short-term notes payable, we only paid interest once at the end of the term of the note payable. Bonds are going to be different. With bonds, we are going to make periodic interest payments in cash. And remember, we said we're going to do that semi-annually or twice a year. So the number of interest payments, or the interest payment periods is really the number of times that we're going to pay interest. So if we have a 10-year bond and we're paying interest twice a year, we would have 20 interest payment periods. Okay, now we have a contract interest rate and a market interest rate. The contract interest rate is basically the interest rate that's written into the bond contract. That's legally what we must pay. So if we have a contract interest rate of 5%, then every 6 months when we calculate interest, we're going to pay it on 6%, or 6%, if that's what we've agreed to pay in the contract. Or maybe I said 5%. Anyway, whatever's written in the contract, if it's 5%, then we'll pay interest of 5% every 6 months. Now that is an annual rate, so we will have to prorate that by multiplying by 180 over 360, and we'll do that in the formula section. So just know that the contract interest rate is the rate in the contract, and that's what we're going to actually pay, compared to the market interest rate. So the market interest rate may be different than from our contract rate, especially if we have something like a 10-year bond, because our contract interest rate won't change. But of course, the market interest rate changes all the time. So the market interest rate is defined as the current interest rate that a lender could get on the open market for a similar instrument. So bonds, company bonds get rated. You can have AAA, AA, B. So if we have a AA bond, it's what kind of interest rate a lender could get if they bought someone else's AA bond. And so that's going to be important as we start looking at how much cash we actually receive from our bonds, because it may not always be par value. Our next definition is the issue price. That is going to be the price that we actually sell the bond for. And it's going to be expressed as a percentage. So for example, if we have an issue price of 102, that means 102%. It means we're selling the bond at 102% of par value. So we would take the par value and multiply it by 1.02, which would be 102%. If we have an issue price of 95, that means that we are selling the bond for 95% of par value. Which is to say that when we sell the bond, we don't always get par value. Par value is what we have to pay back, but we may sell the bond for more or less than par value, and we'll get to that. The interest payment, that's the amount of cash that we pay every 6 months. In our case, it's every 6 months. So every 6 months, we make a cash payment, and that is our interest payment. Discount. The discount is if we sell the bond for less than par value, then we have a discount, which means that we sold the bond for less than what's on the face. This happens if the contract rate is less than the market rate. So basically, if I'm a lender and I could go out and get 5% on the open market, and you want me to buy your bond that's only paying 3%, you need to incentivize me. Why would I buy your bond? I can get a better interest rate somewhere else. And you incentivize me by giving me a discount. So I'm not going to pay the full face value or par value of the bond, but I will get that back at the end. A premium is just the opposite. A premium is when we pay more than the par value of the bond. So for example, if our contract interest rate is still 3%, but now the market rate is 8%, then if our contract interest rate is 3%, but the market rate is 1%, then our bond is actually a better deal. And so we say, hey, if you buy our bond, you're going to do better than you would do at the open market. And just the way the free market works, that's going to allow us to charge a premium. So we can actually charge more than the par value or what someone's going to get back at the end, because they will be making a higher interest rate. The interest expense is, actually, let me go back to discount premium. So when we sell a bond at a discount or a premium, that is going to be amortized. You might remember amortization from when we talked about intangibles, and this is just a different kind of intangible. And so the discount and premium, we are going to use it to either increase or decrease interest expense over the life of the bond. And we're going to amortize it every time we make an interest payment so that when we retire the bond, the value in the discount or premium account is zero. So we're going to use it up over the life of the bond by either increasing or decreasing interest expense. Interest expense is going to be the amount of expense that we actually book to the income statement after amortizing the discount or the premium. So we're going to start with the interest payment, and we are either going to increase interest expense if we're amortizing a discount, or decrease interest expense if we're amortizing a premium. Okay, I think that does it for our definitions. So in the next video, I'm going to show you the formulas you're going to need to calculate all of this. See you then.